Hi, everybody. Very warm welcome from our side to this today's innovation talk. First of all, I want to say a big thank you to Ernst & Young, our hosts of today's session here at WaveSpace Munich. Really to say impressive location to have a session like this. SPAC, Special Purpose Acquisition Company. One of the latest trending topics in the financial market. At the moment, hundreds worldwide are looking for targets, offering them a kind of shortcut to going for public. Lately, this trend also arrived Europe and the German market. But what is a SPAC? How does a typical transaction look like? And what are the kind of targets SPACs are looking for? This session is intended to give you kind of a practical overview about what all those questions are and answers for this, but also giving you some kinds of tips and hints from all our guests that we have here today at WaveSpace. But before we start into the discussion, I would like to introduce you to our guests here today at WaveSpace, but also, as we are a hybrid event, to one guest abroad in Australia. So let me start with you, Thomas. Thomas, hi from Munich to Australia. Thomas Ulmer is former CFO of Immatics and the current CFO of Global Kinetics. Thomas, very welcome, and you will be the practitioner today, giving us your point of view. Really went through one of the first transactions.
Warm welcome from my side. Good day and good morning back to Germany.
Second point of view we're going to have is the advisor and experts point of view, and I would like to introduce you to three people. First of all, Katharina Rapp. Hi. Katharina is associate partner at Ernst & Young International Tax and Transaction Services. Second, Martin. Hi to you also. Martin Steinbach is partner, head of IPO and listing services at Ernst & Young. And thirdly, Michael. Hi also. He's partner business tax services at Ernst & Young. And thirdly, introducing my dear colleague, Johannes. Hi, Johannes. Johannes is a managing partner at UnternehmerTUM Venture Capital and will give us his investor and founders perspective. Hi to you all. So before we're going to start our discussion with the five of us remotely and here at WaveSpace, I would like to hand over to Martin to give us some kind of brief intro to the space topic, SPAC topic, to understand more a bit about. Cool.
Thank you. So let's start the brief introduction. And also, hello, everyone. And the first question, what is a SPAC? A SPAC is a cash shell with no operations. They are listed predominantly in the US, and they have a lot of cash in a trusted escrow account. And the purpose is to really acquire a company within 24 months. And one target area for those SPACs is Europe or EMEA. So let's have a look at the first slide, which is about SPAC activity. So what we see over here is you see that SPACs are all over the place, and it's not a new phenomenon for capital markets. We see it each year. From a target perspective, it is an indirect way to go public via a SPAC merger. But what happened in 2020, you see there's a peak, and we all know the pandemic joined the capital markets, and typically SPACs the SPAC activity is increasing when markets are volatile. So it's a lot of uncertainty. And as we remember, and it starts in March last year, we see a constant increase of SPAC issuance in capital markets. So you see also this momentum moved on in Q1 2021 this year, and a bit of decline in the second quarter yet. This has a lot to do with potential new regulations from all regulators, from the SEC, the ESMA, and also from the FCA. And you see that when we look at SPACs, which are really still active in the market, we have around 420 because they have a lifespan of 24 months. So those who launched early 2019 or 2020 might already found a transaction. So what are those targets? And as mentioned, when you look in the prospectus of a SPAC issuance, you see the typical acquisition strategies. So what we can see, there are strategies with regards to region, with regards to sector, and also the size of a SPAC really determines the target. And today we have also 18 SPACs from Europe, also listed at European stock exchange. And together with the US listed SPACs, we have over 134 billion US dollar in cash. And this will be multiplied via so-called private investments in public equity. And when we are looking at the regions, so 89% of those SPACs are completely flexible. They can invest in any region in the world. But typically, with the most predominant area is Americas. Whether when we look at the sector, 29% are open, so they can acquire a company maybe according to region. But we see also in the transactions here in Europe, there's a huge interest acquiring technology companies, and May Thomas can also shed some insights on the healthcare sector, which is the second most prominent sector for SPACs. When we look at the size and the issuing volume when the SPAC goes public, so typically on average we have 350 to 400 million euro in an escrow account. And if we really calculate the pipe, they have a deal power of over 1 billion euro. So this is quite a sizable transaction and way to go public. So let's have a look at the target side. Let's have a look at the typical life cycle of a SPAC. And this is a US example. I think it's quite similar in Europe. It depends also on the capital market law, also on the corporate law in the country of domicile, where the future SPAC merged entity is domiciled. But let's have a look at the typical US SPAC cycle. So it starts with a regular IPO or issuance. So they raise funds, they have an idea. They typically have really renowned sponsors. So this process takes 3 months. They are listed at a certain stock exchange in the main market. They issue units and also warrants. And here the 350 to 400 million proceeds joining the SPAC. The cash is in an escrow account. Then they are starting to look for and seek for targets. And this takes up to 24 months. So 3 plus 20 is around 24 months. So, and then they are identifying, going into negotiations with potential targets. They sign letter of intents, doing due diligences, and then they finally agree with the shareholders of the target company in a business combination agreement. In parallel, they also approach together with the SPAC, the target company plus the SPAC. They are looking for further funds really to multiply the volumes in the escrow account. And this process from then they have to do a proxy statement, an S4 or an F4 for US purposes. They file this proxy statement with the SEC in order to get approval, and finally the SPAC investors general meeting have the say whether this transaction is accepted or not. If they accept the transaction, the new company is kind of born and will be listed at the domicile of the SPAC. And in the US case, it will be then a US listing on NASDAQ or NYSE. In a European case, it depends whether the SPAC really went public. There are 3 to 4 dominant stock exchanges. It's Euronext, London, Deutsche Börse, and also Italy, and NASDAQ First North are those listing locations. Okay, this is very simplified, but really shows the typical cycle. And if the SPAC didn't find a target, it will be liquidated. So there's a kind of pressure to find the respective target, after 12 to 14 months, because the whole filing process, also due diligence process, takes also time to consider. Okay, so yeah, please.
Question. You say they're looking for targets, the SPACs. Do you know for how many targets basically they're looking and how many are really negotiating? In the end, they are only picking one. But is it that they are looking at 100 and then boiling it down, or do they know exactly already what they want to invest in?
Good question, thank you. I think as those sponsors of the SPAC are well-known sector experts, they already have a clue who they want to target, and this will be also displayed in the acquisition strategy. So yes, they are in parallel with many companies within negotiations, because also SPACs are competing with the traditional IPO route. They are competing with PE, with VC, with strategic investors, with M&A. So to create competition for the best price is key. Okay, let's move on. What are the typical, checkpoints from a target company perspective? I think the first thing is, really checking the sponsor quality to better understand the SPAC. But also, as we know, the filing process takes 3 to 4 months. So you need to really deliver the respective financials and the financial statements in a shorter period of time compared to a classical IPO. So this is a lot of time pressure, and you need to ask yourself, is your team ready to meet this goal? Then it is also a question of, what's the best route, and you need to really calculate based on valuation what's best for us as target company, considering the sponsor promote the 20%, but also the potential underwriting fees of investment banks. And then last but not least, will be a topic also today for EY. What does it mean on capital market readiness? Because you need to be ready for public markets. We call it IPO readiness from a target company perspective. And let's have a look at those typical areas. So we have 8 kind of capital market or SPAC or IPO readiness areas. The first thing is to really understand the transparency requirements of the stock exchange and also the regulator initially and ongoing. Then the second is to really, and this is a handshake with tax, to understand what is the future company, the issuing company, the vehicle, in terms of domicile, qualification. There are lots of questions. The third thing is about tax optimization from different perspectives, the target company perspective, but also the SPAC perspective. Then we come to financials. There's a huge effort in, establishing the right financial statements, maybe interim financial statements, pro forma statements, so to prepare for the life as a public company. Then systems, when it comes to the US, SOX readiness comes in, but also in the European environment, it's all about internal controls, risk and compliance management systems. Then in the 6th box, the new functions coming on your way. So you need to have an investor relations officer, someone who takes care about compliance, but also someone who takes care about the new corporate governance as a public company. And this also influences the composition of the leadership. So 1-tier board, 2-tier board, diversity of boards, and last but not least, timeline. As mentioned, this is really a tough thing to get ready in a very short period of time. And the question is how you can reach this with a proper and stringent project management. And this was really quick run through many considerations, and maybe we find a deeper dive and time in our discussions.
Cool. Thank you, Martin. So this was, I think, a great overview for all of us to understand a little bit more what SPACs are all about. So Thomas, now heading over to you to Australia. As I just introduced, you are the kind of the practitioner in that field because you've already went through a SPAC transaction by yourself. Maybe start with the first question. When did the first idea come across to think even about a SPAC transaction? Maybe you can give us some insights on this one.
Sure, with pleasure. To be honest with you, it was actually an accident. And it was not planned that, so Immatics had a wonderful pipeline, and what we wanted to achieve is to fully capitalize the company that we are able to achieve for the benefit of our investors, of cancer patients, the next inflection points. And therefore, the approach that we took is, what is the best way to fully capitalize the company? And the piece that was missing for Immatics, we had a wonderful and supportive shareholder basis, but it was by and large a European shareholder basis. And what you want to have, especially as a biotechnology company who wants to list in the US, the ideal setup is that you have a reputable US biotech investor as part of your shareholder register that has the financial horsepower, but also obviously the understanding of the sector to actually lead the company to a publicly listed company. And the objective that we had as a company was to find that crossover investor who would help us not only to secure the funds as part of the crossover, but also then successfully accomplish the IPO. That didn't go that way. So what happened is, as part of the process, where we discussed with many US investors, and actually this was more or less 2 years ago from today, that we started the process actually in person in New York, which is a bit strange to mention this nowadays, that we actually had our first conversations with US investors, whether they would like to form part of the crossover. And as part of this process, we were offered the SPAC opportunity. And I still remember when myself and the CEO looked at a SPAC, what is that exactly? And we had looked into a couple of like reverse merger options, which is a little bit similar because it's effectively kind of like access to a listed vehicle, and which has typically a bank account that is attractive, but it had a negative connotation with it. So we were quite comfortable that this is not the pathway that we wish to pursue. But then the more we looked into that and also discussed this with our board, the more excited we became, because what it meant for Immatics, that we would effectively combine 2 transactions into 1 transaction, which would be the crossover and the IPO.
Cool, interesting. So you mentioned now it was by accident. So when do you think is a SPAC transaction best for a target, for a company? What is your thoughts on this?
It's a very good question. And to be honest with you here, I would say, I mean, a SPAC transaction is effectively a combination of a crossover and an IPO bundled into 1 transaction. So the crossover, also what Martin mentioned, is typically the concurrent PIPE, the private investment in public equity, that is accompanied as part of the transaction. And the IPO is the merger of the entity into the listed bank account or the entity that it will be merged with. And the question that I asked myself, and obviously others should ask the question for the respective company, is the company ready to be a public company? And whether that's done via an IPO pathway or whether that's done via a SPAC pathway, it's still what it comes back to or down to is the fundamentals of the company. What is the unique selling proposition of the company, the technology, how does the technology or the product compare in its quality development stage or market opportunity with peer companies that are public companies, and at what valuation are those companies public companies. And it is a combination of the product, the technology, and the human factor in terms of who are the people that are translating the scientific knowledge or the product into development stages, into advancing the company. So what is the people that are driving, and the trust on the people that investors should have to drive the technology forward, and what are the value inflection points? So that really translates then into the equity story and what the company is able to offer to investors in terms of the inflection points that we're able to deliver in a kind of a time horizon of 1 to 3 years. And ideally, like how many shots do you have on goal? It's much more attractive and balanced if you not only have like one shot of goals, but multiple shot of goals, because if you are working in a fast growth environment, some things cannot go sometimes according to plan. So it's good to have like something in your back pocket and to have multiple options.
Interesting. So as you are, or as you have to be, you were the CFO of the company. What are your kind of lessons learned when it comes to the next SPAC, potential SPAC?
Really, for me, the interesting piece was, I mean, SPAC ready, as I said, is nothing else but becoming IPO ready. And what Martin showed is the different elements of becoming IPO ready. But when it comes down to what my learnings are, is the key difference in a SPAC transaction versus like an IPO. I also call it kind of like a reverse IPO, because in an IPO, you have the price negotiation at the end. In a SPAC transaction, you have typically the price negotiation at the start of the process between yourself and the sponsor. And once the price negotiation is done, the focus is on execution. And that's actually quite exciting. So the chances of success in a SPAC transaction, once you've had that binding term sheet between yourself and the sponsor signed, is actually fairly high. I'm sure Martin has got the statistics, but I would estimate that this is like 90+% that actually once this is signed, that also the transaction is successful. But what I would recommend is, I mean, you have from signing the term sheet to becoming a listed company, it takes roughly 3 to 6 months. You have a lot of time to get ready, and you will also be supported by advisors, lawyers, consultants who will help you. But if you want to become a public company, I would, however, start early to transform the finance function. And that means in terms of upskilling the finance function, and to decide on who would you like to have as an auditor, that once you're a publicly listed company, that you're comfortable with the relationship between yourself and the auditor. And when it comes to the finance function, because a lot of like these high growth companies, they have very light IFRS statements. And it really like is a different skill sets to deliver between like light IFRS statements to PCAOB compliant financial statements. And that skill set is typically not there in a startup environment. And this skill set is not something that comes within like a month or 2 months. So really from the time that you decide that you would like to consider to become a publicly listed company, get yourself ready early how to want to transform the finance function. And the other most probably key lessons learned was for me is make sure that you really understand how the end-to-end process works, from kind of like signing the term sheet to kind of like being a public listed company. So in our case, it took me kind of like a month or so to figure out what kind of like the documents and everything else we had to produce. So it would have been helpful if we actually had known Musabi a little bit earlier, but I think we were fairly quick based on feedback that we had received. And Musabi, the last key lesson learned, and we were quite lucky in that, is to have an excellent project manager. And so in this case is ideally a person who does not necessarily need to have like a strong financial or a financial background, but really needs to understand the business very well. And we had actually an excellent project manager who really understood very well what's happening in the company and how to translate this into like what investors and legal people want to hear. So I think that's also a key lessons learned is make sure that actually a really good project manager is driving it, and we were very fortunate in our case.
Thank you. So we come to the expert point of view later on. So maybe before we talk about the investor and founder perspective, Johannes. So I mean, you listened to Martin's introduction. You have a clear long-term background in venture capital, founder by yourself. So when you first heard about SPAC, where do you see the general kind of opportunity in SPAC for, let's say, your founders, you also investing in, but also from the venture capitalist point of view?
Yeah, for us, sorry, this is a really interesting opportunity. First of all, on a high level, you explained this very nicely. They are sitting, let's say, 200 pots of cash out there, in total 150 billion almost, that want to invest in, let's say, early growth stage companies. So for us as a VC and for our portfolio companies, this is a lot of money that wants to be put into interesting technology companies. And so from our perspective, it's kind of a growth financing potential that's actually increasing dramatically because they're getting money from the public market. And actually then also in the process, as we also heard from Thomas, there are a lot of interesting also opportunities and advantages. First thing, you're not doing only a nice growth financing, maybe with 500 million even. But the interesting part is you're then also being public. I mean, this has also difficulties. The company kind of has to work in the public markets. But being public for founders, for investors, for early investors is very important because we can sell eventually our shares. That's what we're looking for, right? We have a lockup period, so we cannot sell it immediately, but we have the market and eventually can sell our shares. And actually, there are two other very important advantages. In a typical IPO, you're basically looking always as a history. You cannot do forward-looking statements. You cannot do a really big business plan saying, today I'm doing 50 million revenues, in 5 years I'm doing 1 billion. You have to look at the revenues today. In biotech, that's a little bit different because they often don't have that much revenues yet. But in technology companies, so usually in IPO, you really, the hurdle to go IPO is a lot higher. In the SPAC, it's not an IPO transaction anymore because the SPAC is already public. Basically, it's an M&A transaction. So the sponsor has to believe in the business plan the startup is putting on. And this actually gives the opportunity that the sponsors are actually looking more at the future. And this gives now the opportunity that people can go public. It's maybe also a risk, but it's also an opportunity that are in earlier stage. We look at Lilium, that's a discussion going on, and others. So we all know that there are companies now going public and actually attract a lot of public market, maybe in an earlier stage. And based, by the way, a third or fourth very important thing is once you are public, you actually can use your shares to buy other companies, right? And then grow this company even further. So this is very important because if you're already public and have several billion valuation, you can use your shares to maybe buy other startups, other interesting technologies, and kind of build really a large successful company.
Interesting. So Martin just mentioned earlier before that I think was also one of your questions that the SPAC investors have a gut feeling what they're looking for. So they have the kind of their target picture already in their head to make the screening. But coming from the other side, how do you think? I mean, I know how founders approach VCs, pretty easy. But how do you think is a good way to find a SPAC sponsor in this case?
And that's exactly why I had this question. I think this is not so standardized as approaching a VC or a PE firm or growth financing. So some people have already clearly on mind, you know, who are they talking to, and maybe some SPACs are still more open and looking around. So I think M&A advisors, financial advisors playing their big role to channel this, to also, you know, if we go now to our portfolio companies and say, well, you know, maybe the SPAC is the way to go. You need to prepare, you need to put also a lot of resources in. You only want to do this if you also have a good chance, you know, to go there. So you need this information. What are they looking for? Are we already IPO ready, or are we ready for the public market? And on the other side, but also going proactively out to these sponsors to basically pitch your company. Yeah, so that's a process. I think we are still trying to figure out what works best. And that's very helpful, and have advisors and people going out and just talking and understanding how that really works.
Interesting. So maybe a new business idea, spec finder, but another topic. Yeah. So Michael, Thomas just mentioned that it's really crucial to have the right helping hand on time, ideally pretty early when it comes to transactions, spec transactions. So what is the general role of EY when it comes to spec transactions?
Well, actually different roles. It depends whether EY is supporting on the spec side, on the investor side, whether EY takes a role on the target side. On the one side, EY can be the auditor or for the target company, or take the consulting role with different parts, finance, tax, legal. So that's different perspectives we can take. So it depends on the situation, also on the mixture, what the client or what the target is already working with. So we are pretty flexible.
Okay. And Thomas mentioned you called it upskilling the finance function. I would also maybe upskilling the tax function, because that's that standardized business for a tax advisor, I would say. So what are typical work streams when it comes to finance and tax and those transactions you're working on?
Yeah, so I think it's a good point, Thomas, you mentioned. It's project management and multidisciplinary work together. So it's not like in silos thinking. So you have to combine the different work streams. And yeah, maybe I take some examples. First one is finance. You remember the different boxes in the presentation at the beginning, and Martin put the slide deck. As you can see, in the finance, it's the first thing. Once you have decided to take this SPAC way, you need international based financial statements reporting. It's often IFRS consolidated financial statements to be prepared, often for the first time for a startup company. Before, they typically only are required to do local GAAP financial statements, and then it's for the first time either IFRS or US GAAP, depending on the regulatory requirements. And that means you have 2 years period. So you're not only starting in the year where you first time do your SPAC transaction, you also have to go in a year back. So for example, if you're going for a SPAC in 21, you start with 2019 as a full period and have an opening balance sheet in the 1st of January 2019. And then you have to look into first time setup of special items like intangible assets, valuation. You have to prepare so these opening accounts, then first time notes, all the explanatory documentation behind that, and that, as Martin mentioned, within a very short time period to gather that information, and that's why it is very important to have proper management and project management in place. I think then it goes in a finance perspective also with processes and controls. So being IPO ready means that you have to put more structure in your finance function, like you have documentation to be prepared in writing. Even if you have already processes, you have to put them in writing in proper in proper workflow documentations, and yeah, to demonstrate vis-a-vis the auditor to how the functional profile works. Maybe I'll also take some examples from a tech side. I usually work on the operating topics for the startup company, and it comes usually together with internationalization and a transaction like the SPAC transaction. So two hurdles or two new phases at the same time to achieve a new next level of growth stage. And that for tax it means, for example, first time consolidated tax reporting, gather all the subsidiaries information in one consolidated tax documentation, transfer pricing to be revised, special items like convertible loan financing aspects from former financing rounds to be looked at. If you have a startup company, usually have losses in the loss history, then it's important to structure it in a way that you can use this tax losses and shelter them in the future in the next years, though that you can benefit from it. And yeah, last point also on the boxes is processes and ERP system. Sometimes you have usually you have started with a simple ERP or finance system that works for local and private companies, but now with the new target, like being a listed company, you have to pull that information and data out of the system, and that typically requires also that you work at a very early stage to renew and update or expand your IT systems to gather that information.
So Katharina, as you are the international tax expert, maybe we can go one deep dive additionally. What are, from your point of view, kind of the relevant phases from a transaction perspective? And then a second question to the both of you. Are there any hot topics to get prepared with at the moment from your point of view?
So when we think about tax structuring and the phases Martin explained earlier, I would say the tax structuring really begins once the letter of intent is signed, because at that point in time, we do know who's going to be the target and where is the SPAC located. Then the key question here is, where should the future public listed company be located? Because typically the SPAC vehicle as such, the shell disappears in the structuring process. The structuring as such has to consider not only the company's interests, but also the founder's interest, the sponsor's interest, and the investor's interest. So this is a lot of alignment work between all work streams. In parallel to the structuring work, the tax due diligence process is run, and both the results of the tax due diligence as well as the structuring are then reflected in the business combination agreement. So the business combination agreement marks the end of the first phase, I would say. The business combination agreement is then typically published, and after signing, the pre-closing work begins. So what is to be done here? One has to think about how the structure should look like in detail. So for instance, what kind of functions need to be established at the level of the new public company, which people need to be transferred to the new entity, and also the preparation of the legal documentation begins. From a tax point of view, we always want to see those documents to ensure that they probably reflect the transaction steps one has agreed upon in the business combination agreement. Once the closing steps have been executed and the company is public, then I would say the housekeeping work begins. So the company has to be registered with the tax authorities, filings have to be made, and also the preparation of the tax return starts. What all those phases have in common is that they require a strong and continuous collaboration between the work stream and the different advisors groups to ensure that all are on the same page and efficient process can be guaranteed.
Interesting. So what are the hot topics? I would be the guy sitting in that department. What is the hot topic I have to prepare for?
Okay, what I would say is when we think about setting up the structure and how the structure should look like, this structuring is not, or many times not text driven, right? So it's a bunch of factors that come into play here. And at the end of the day, you need to find a structure that matches with your actual reality. So for instance, if you decide to have a public company listed in the Netherlands, or registered in the Netherlands but listed at the Nasdaq, then the question is, does the German management and the German founders of the target actually want to relocate to the Netherlands to manage the company out of there, or is this a no-go? So yeah, I would say tax follows business here. This is a key point.
Okay, good to hear as a Bavarian to stay in Munich. So Michael.
Yeah, maybe a few other topics where we see the multidisciplinary of the project. One topic is a lot of startups have employee stock option programs. And so that's an important point in the communication with HR at this target or at the startup company to get the people motivated and bring them also on track and get them motivated for the future. And what does it mean when the SPAC transaction actually happens? Is this an exit scenario that they stock option can be vested? What does it mean? And so there's a lot of communication and also detailed legal and tax work to be prepared. I think that's one hot topic. Then also you have to look at prior financing rounds and investors. So there's usually convertible loans in place, and so it's an alignment with the investors. Does it mean that those loans should become converted at the time when the SPAC transaction actually being closed? So those are topics to be prepared ahead. And lastly, I'd say it's the hot topic at the beginning is to set up the right project management to get at the very early stage a clear view. What are the topics, the different work streams, who is in charge for what work stream, what is the team of advisors, and what is our team, what can be done in-house, what can be done with co-sourcing, and what must be outsourced, and to get this plan at a very short time frame at the beginning, and that makes a successful SPAC transaction, I'd say.
Thank you. So Martin, I mean, the time when I first advised IPO is kind of more than a decade ago, but I remember it was a tricky time. So, but now comparing SPAC and traditional M&A transaction, what is the difference from your point of view?
So I think there are many paths to public markets. One is our topic today, to de-SPAC, to merge with the SPAC from a target perspective. Thomas, you mentioned reverse IPO. This is also a path that exists for a long period of time. Direct listings. So there are many ways to go public. But if we compare the traditional kind of IPO with the de-SPAC, and we talked about this. One thing is that a traditional IPO takes time to prepare. It's 12 to 24 months. A merger with a SPAC is it's a fast track to public markets. So time pressure is the first difference. And this is driven by the regulation, the proxy statements, to prepare the proxy statement, and the whole approval period. And I think the first thing was mentioned by you. It's not just that you have the price discussions up front. You have a kind of price certainty, because it's a combined M&A and IPO transaction. So price certainty, and if you remember what I've said at the beginning, SPACs are always popping up when in the market we have a huge uncertainty. For me, in my lifetime, it's my second wave of SPACs. The other one was 10 to 15 years back when we entered the financial crisis, and we saw the same uncertainty. So price certainty is a difference. Also transaction certainty. end of day, the general meeting of the SPAC have to say yes. It's not just the yes in the business combination agreement between the sponsors and the target company. It's end of day after the approval with the SEC or the European regulator plus the general meeting. And then it's it's also a fast track to get IPO ready. Remembering all 8 boxes. And this is a lot of pressure for the team at the target company. And Michael, you mentioned the incentives. So this is day in, day out, day and night work, especially with the US. When you go public in the US, this has certain additional requirements. Thomas mentioned PCAOB standards with regards to financial statements, but also potentially converting into US GAAP because depending on the structure, IFRS is not applicable. You have to go to US GAAP if you are qualified as a domestic issuer. Just to mention a few things.
Cool, thank you. So maybe one question to the 4 of you, so the advisor experts and also Thomas, but please only one statement. So what is the number 1 IPO readiness gap you see in the market? So maybe Thomas, what was the number 1 gap to get ready for the SPAC? And then also Martin, Michael, and also Katharina.
I do believe it was the readiness of the finance function and to help us to get to have this deep understanding and from producing obviously like capital market compliant financial statements. And that's most probably the biggest gap we had to overcome. But luckily enough, we started with that already quite a while earlier because we knew we wanted to become a publicly listed company. We started like investing into upskilling the finance function.
Thank you, Katharina.
So I would say don't underestimate the work that is to be done between signing of the BCA and then the final listing, because there are so many details you need to prepare for, and yeah, there's a lot of time pressure.
Martin, Michael.
Okay, I take the next tax lead. So yeah, I'd say it's the preparation of it goes in the finance direction, finance function, where tax is part of it, and that means a lot of documentation of tax history over at least 2 years. I think that's the biggest challenge to wrap this 2 years up and within a very short time frame.
I think the most obvious IPO readiness gap is there is no financial disclosure organization at the target site, because going public, it's just a transaction. It's a transformation from private to public. And as a public company, there is a so-called investor relations organization required. It means not just whining and dining, it's hard disclosure. When it comes to European or US markets, annual financial statements, half-year financial statements in a minimum. Best practice is all over the world. Quarterly financial statements, they have to be established and prepared by the finance department. But those guys who are disclosing it and presenting it have to be on board. And this also impacts all department heads and colleagues around investor relations. Look at HR, stock option plans, managers transactions, legal, preparing general meetings in a public environment, taking care about insider lists. Look at leadership, diversity, gender quota, corporate governance declaration comes in. The tax department, you are in a spotlight, and we have more transparency vis-a-vis authorities. What else? The compliance and risk officer, they have additional compliance on top of the sector compliance in your business sector. The capital market compliance joins. We are talking about segregation of duties. So the whole team is involved at the target site. There's a bright future in capital market, but this means also that you have to have a process that is regulatory compliant.
Okay, thank you. So this was now quite a deep dive we had. Getting one step back, Johannes, I know you're quite into the topic, what this all has to do with the European innovation market. So as we also come to an end, where do you see the opportunities and risk of SPAC for the overall innovation market from your point of view?
Yeah, that's a very good question. So I think it's really an interesting trend. It seems that there's a lot of money out there in the public markets that not only want to invest, let's say, in cash generating stable business, but really want to invest in innovation generally. And I think this is a change, especially in Europe. In the US, it was always the way. In biotech, by the way, it was also having, we all know, for our health system, people invest, but in especially Germany and Europe, to have really IPOs that go into an innovative company that might change the way we work, we travel, whatever, has not really happened so far. And I think this now opens up a really chance for us, especially again for Germany, because back then we had a lot of startups 10 years ago. We had to sell them, let's say, for 100 million to a larger corporation. What happens then is in these larger corporations, even though they're very important for our economy, but often innovation is not, their strengths. So maybe it's a lot better for our economy to put more money into maybe already a startup and then a grown-up maybe, but still a smaller company. And with the SPACs, I think we have the chance to do that. And so that's a big opportunity for all of us. The risk is, do we keep these public investors? Expectation management. If you now give them, let's say, a startup which is really still at risk, again, it's not a stable company yet, and the public investors invest in it, and after 2 years they say, well, it doesn't work. This is my fear, that we kind of overdo it at the moment a little bit in terms of valuation, in terms of readiness. So I think we have to find a good middle way. There are still more innovation, they are more risky, but try to have enough also of them that we have good cases that work. If we have 10 and one won't work, okay. But if we have only 3 and 2 won't work, I think that's a problem. So let's say work together to really make this happen, because I think for us and Germany and Europe, it's a good way to bring back public investors into innovation.
Cool, thank you. So first of all, thanks for the great insights. At least for me, you cleared the SPAC sky a little bit. So to round this up now, as we are at the end of our time, what is your number one learning nugget out of the session? And please, only one word. I can actually start. For me, it's project management. I was really surprised about this one. So what is your number one learning nugget out of today's session? Maybe we start with Katharina, then Michael, Martin, and Johannes, and Thomas by the end.
Actually, I would also say project management.
Interesting.
I'd say you will become a listed company, and we will stay a listed company. So you have to fulfill and be aware of that mindset.
Yeah, start early, ideally with an IPO or SPAC readiness assessment to prepare for all options.
So my learning was, we have the processes, we have the people, we have the targets. So let's do it.
Thomas?
My learning is just a recap of what we as a company went through kind of like 12, 18 months ago, and the complexity of it to run actually a SPAC transaction successfully. And really, it may sound complex, but actually when companies choose that pathway, it is actually fairly smooth sailing, because there's people around that actually know how to bring this to success.
Thank you, Thomas. Thanks again to all of you for joining us here at Wavespace today. Thomas, thanks to you for actually giving your evening in Australia to our session. Thanks for tuning in and listening to this fruitful discussion. If you want to understand more about the work of all these guys who attended the session, you are, I would say, familiar with social media tools, you can reach out to them. Thanks and goodbye.